It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
The tax cuts that came during the Trump administration are scheduled to expire at the end of 2025. That's going to be a big deal. So the question is, should you be planning ahead for the aftermath of when these rules sunset just a couple years from now? We're going to be covering that and more on this episode of the Wise Money Show.
It felt like, okay, that's way out there. Yeah, we don't need to worry about it. And then all of a sudden, this tax season, it felt like, oh my goodness, it's right around the corner.
Right.
And we've been talking about it with our clients. We want to talk about it with you. If you have a question, have any needs for the program from us, we're happy to help. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. And you can submit questions that way as well as learn more about the show and the firm. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. I don't know how you wake up in the morning. Some people, and I've started this habit this year, my wake up is go for a run. And then I also need coffee to wake me up. Some people, I don't understand these people, but they wake up and they're just automatically happy. They just are alert. And then others need to hear some crazy facts about our national debt to really just get them alert and awake in the morning. And if that's you, you're about to wake up. So we have crossed $31 trillion.
Wow.
They've got this website, what is it, National Debt Clock? I don't have it right in front of me, but oh my lands, $31 trillion. And if you look at it, just even over the past 10 years or by decade, it's exponential is what's happening right now.
Have you ever sat and watched that clock running?
Oh, yeah.
I don't have a sense for how many millions or maybe it's thousands just every second it's growing, right?
And obviously...
Okay, I'm about to leave.
No, you're supposed to wake up, Mike.
We've been playing chicken with the debt ceiling again, and... gosh, and guys, this isn't a show about politics, it's about financial planning, personal financial planning, but it does seem like that's just pandering because there's nothing that they're really going to be able to change. But when you look at the deficit, at least for 2023, $1.4 billion, that's 23% of their overall spending they've got to borrow. And so, Houston, we have a problem. Like, there's an imbalance here.
It's 1.4 trillion.
Trillion?
Yeah.
Yeah. Okay. My bad.
I mean, it's only some extra zeros.
Yeah.
At that point, it's all irrelevant. It's hard to... I don't think the human mind can really even fathom how big 1 trillion is.
Nope.
And so that's what's so alarming about, some of the budgeting habits that, take place in Washington, D.C. It's like, folks, do we even realize what we're doing here? And I don't know about you guys. How often do you have clients that come in and they're just alarmed about the debt? Do you guys get that question very often?
Well, yeah, I mean,
yes.
But the thing is, how stimulated can you stay over what period of time?
Yeah, right.
Because this is where it just kind of wears people down and wears them out, and finally they shrug and say, well, I'm going to play the game the way the game needs to be played. When the music stops, I've got a chair identified. Hopefully I can make it to that chair and sit down, but I'm pretty sure there will be lots of people that won't have a chair when the music stops.
Mm-hmm. So you don't have any control over this. You've got a little bit of influence in how you vote, but even that, there's not much. What you do have control over are your own financial decisions and whether your financial house is in order. And my goodness, are we passionate about that, especially, right, because that's the chair Kevin's talking about. And so, okay, it's with that backdrop of what's going on financially for our country that I want to get into the headliner topic today, and that is current tax rates and tax laws are scheduled to sunset at the end of 2025. And that's not, eons from now. That's a couple of years. Back in 2017, the Tax Cut and Jobs Act was introduced, sweeping tax law changes. And it on average, it saved about $1,200 of tax per person. And we do a lot of taxes, and that was about right. Now, did it save $1,200 for everyone? No, it didn't. Did some people actually pay a touch more? I think I had one or two pastors, I think. But for in general, this was a tax savings. Oftentimes when they make these big tax laws, they say, hey, let's pass this thing and let's draw a line in the sand out there in the future where everything goes back to normal. So if we don't like it, it'll just go back to the way it was. Well, that's coming up.
Or if you really do like it, you better reelect us so that we can keep this party rolling.
Yeah, right.
It's an interesting political game that they play because, I mean, ultimately, there are tax increases baked into the tax code right now that if Congress at that time just sits back and does nothing, they're gonna increase, right? They don't even have to be the bad guy. They can just point back to, yeah, these are those laws that, were never made permanent, and this is just the way it's going to be.
I actually think there's a growing likelihood of that happening, that no one will be the bad guy. They can actually blame the other side, and the end effect is you're going to pay more taxes. So let's get into some of those. What are those differences between basically the 2026 tax laws will become the 2017 tax laws if nothing has changed. So let's talk about, compare and contrast current tax laws to what they were back in 2017, what they'd sunset back to.
I think one that has a lot of planning implications is just a reminder. We all need to almost kind of go back to the history books here and remind ourselves that back in 2016 and earlier, the tax rates that everybody paid were higher. The tax brackets themselves, you started out at that time in the 10% tax bracket, and if your income got high enough, you got to the 15% bracket, and after a while, you got up into the 25%, 28%, and so on, and you just kept on rolling all the way to 39.6% if you were the highest income, wage earners at that time. Well, now almost every single one of these tax brackets got a haircut. They got reduced over these recent years when the Trump tax cuts went into effect. Right now, the tax brackets go 10 to 12 to 22 to 24 and so on, and they cap out at a little bit lower rate. If all of those go back to where they were before, which technically was a relatively low level by historical standards,
still,
right?
Yeah.
But still, if every single tax bracket now is a little bit higher, a little bit bigger tax bite, then everyone ends up paying more taxes in the end. And that is puzzling to a lot of people because in their minds, out there in the future, when I'm retired, I'm going to be in a lower tax bracket, right? Maybe you'll be in a lower tier, but what if that tier has a bigger tax bite attached to it because the rate itself on your bracket is higher? And so this to me has a lot of implications. We talk an awful lot about the Roth IRA and what if you could pay your taxes now and have an account that you can draw on tax-free in the future. You would care a lot less about what the tax brackets are out there in the future if they do go up, not just going back to the old rules, but what if they went even higher in the future? Roth IRA helps insulate you from that.
We're going to get into what are the planning implications. Should you make any changes right now based on the potential that these tax laws sunset? I completely agree, Josh. In the old, currently, you can get all the way through the fourth tier, and that is 10, 12, 22, 24. Get all the way through the fourth tier and still be paying less in a effective tax rate and overall tax bracket than the third tier in the old tax laws that might become the new tax laws. Kevin, we're approaching a stop here, but what other changes? What are the other differences in the tax rules?
Well, as Josh mentioned, the tax rates themselves would increase. The SALT tax limitations, which is kind of like saying ATM machine, but the SALT limitation of $10,000 for state and local taxes goes away. And right now, you say, well, what difference does that make? Well, if that goes away, I might be less interested in the pass-through entity ability to pay my state taxes at a corporate level instead of a personal level. Now, that's a little bit complex, so forgive me for introducing that. But it does mean something if you're a business owner.
So, okay. And we're winding down to, well, what adjustments do you need to make in your planning today? So a lot more compare and contrast with these tax laws, and then we'll get into that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning, also on podcast at the same time, but also on a couple local radio stations as well, which is why the content is structured the way that it is. For more content and even shorter content, more direct for you, we've got Next Wise Step videos that air right here on this channel every weekday. So make sure you hit that subscribe button, turn on notifications, and if you like the content, leave comments as well. We appreciate it. All right. So we barely even scratched the surface with the tax rules.
Yeah, I mean, it depends on who you are, right?
Well,
so I mean, if you have kids, then you need to be planning for your credits going down.
Yeah. So let's get into all that.
And really, to me, the big one is the estate tax, because there are currently people. Let's get into it on the air.
All right, here we go. The clock's a ticking, right? And we are on path for the tax rules to sunset back to where they were back in 2017. The question is, should you be making changes to your finances right now in preparation of that? We're going to help you with that and more. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, all over social media. Search the Wise Money Show. Okay, current tax laws from the Tax Cut and Jobs Act 2017, they're set to sunset at the end of 2025. So 2026, all the tax rules will mimic and match what the tax rules were back in 2017. And you might say, oh, that wasn't that long ago. And I bet that's not that big of a change. It's a huge change. Not only when we already established this, tax rates would go up, tax brackets would be squeezed, they'd be smaller. So rates would go from 10, 12, 22, 24, and so on. They'd go 10, 15, 25, 28. But the brackets themselves actually would be tighter. And that would be, especially with, how we have seen these expand due to inflation, if they don't do anything, they contract again, sort of like that accordion. So what are some of the other big changes? Kevin mentioned the SALT deduction. Well, he kind of sort of went deeper. I would start by saying the standard deduction changes and personal exemptions. Josh, what about that?
Yeah, taxpayers have always had a choice on what type of a write-off they're going to use. They can either take the free option, already built for you, standard deduction that the government allows you to use, which used to be a good amount, and then it became a huge amount and has gone up even ever since. Today, a married couple can, here in 2023, take a deduction of $27,700.
Just by breathing air.
That's right. And it's even higher if you're over age 65. They give you a little sweetener. So what that means is less people than ever are actually creating their own write-off, which we refer to as itemized deductions. This is where you can write off things like your medical expenses, your state and local taxes that Kevin was referring to, real estate taxes, that kind of thing, even the taxes on your vehicle in many states. That stuff was capped, but it's still countable. Mortgage interest is another big one. And then charitable contributions. All these things go into a calculation to figure out, can you build your own deduction, your own write-off that's better than what the government is offering? Well, the government is offering such a huge one that very few people do that today. But what did it used to be?
Yeah.
It will go back to $13,000 instead of almost $28,000, cut by more than half when these rules sunset. And, these days, more and more people would go back to creating their own deduction. That could be a good thing for many. But it's for some who were never going to be able to build their own itemized deduction anyway, this standard option that is so large right now is a really sweet tax benefit for them.
Yeah, it is. The other thing that would be reintroduced is exemptions. And no one thinks about exemptions anymore unless you're filling out that W-4, because that's one of the questions. How many exemptions? Well, it sort of doesn't even matter anymore. You don't get an exemption deduction. Well, in the old world, you did. Every person in the household, what was it, $3,000, $4,000, something like that. You got this just blanket deduction. A lot of states still offer this, by the way. And so your standard deduction would get cut in half effectively, but a new deduction would be allowed, and that's the personal exemption deduction. But yeah, a big change.
My prediction, if it sunsets and everything goes back to the way it was, that will be the year all of the CPAs retire.
Yeah.
Because the amount of changes your tax preparing professional has had to deal with, and a number of these changes after the fact, it is just overwhelming. And when I think, okay, the personal exemption, which was eliminated under the Tax Cut and Jobs Act, will be reinstated, it just makes me tired.
Yeah. So you might say, okay, well, if the personal exemptions come back, I've got 3 kids or 4 kids or whatever, I'll get a big deduction. Well, hold your horses. The child tax credit was expanded significantly from the Tax Cut and Jobs Act and would reset as well. Kevin, what are those rules?
Well, Josh, why don't you give this one?
So I'm trying to remember what they used to be. Was it
$1,000?
$1,000?
It was $1,000. Kevin, I just saw it on your computer.
I know. But I'm so humble. I just want Josh to
I
have
appreciate that.
5 minutes of fame here.
So, there have been times, especially during the COVID crisis, where these numbers got expanded even more, right? Mm-hmm. And so if all of a sudden you've got child tax credits that go from a couple grand down to $1,000, cut in half, I mean, those tax credits are one of the best parts of the tax return, because it literally, after you've calculated your tax, then the credits are applied and they're eliminating tax at that point. It's the most lucrative part of the tax return. So to give up tax credits is a really big deal. Right now, there's a new tax credit that came into effect during the Trump administration, and since then it's been kind of expanded. $500 for non-children that are dependents. That didn't exist prior to these rules. So all of a sudden, there may be some credits that don't just get reduced, they get eliminated.
Yeah. Another deduction was created, qualified business income deduction, which is for many small businesses that qualify. Small businesses do qualify. You get a deduction of 20% of your profits. So think for a business, you've got your revenue minus your expenses. You then have your profit. That's what you pay tax on. That's true. But then further down on your tax return, 20% of that profit is now deducted off of your return. Significant tax savings, which I would argue, helps create jobs and all sorts of things. And so that was introduced, and that would reset.
Right. And it also helps people keep the entity structure of an S Corp instead of having this mass migration from S Corp to C Corp. Yeah. So there are all kinds of reasons why these things have occurred, and people have done planning around, well, how do I maximize the qualified business income deduction?
Yeah. Okay, guys, that hits most of the changes.
Well,
any others?
Well, I think the big one is the estate tax.
Yeah.
So when I started my career, the estate tax deduction was $600,000 per couple. So together, a couple, if you both use the max coupon, you could pass $1.2 million to your heirs, federal estate tax free. So you say, well, what is the federal estate tax? Well, when you die, they take everything that you own and they add it up, plus any life insurance proceeds that were received, and there's a number of other things, and they say, okay, above this threshold, the federal government is going to take their chunk. And those numbers have grown, and it looks like if it's sunsetted, like today, think in terms of about 24 million, but if it's sunsetted, it will go back to about...
So 3 or 5?
Yeah, I think somewhere in that neighborhood. It could be 3 to 5 to 7. So it's going to be a number.
Yeah.
And
Much less than what it is
Much
today.
less than what it is today. And so if your net worth is $25 million today, you're feeling somewhat safe. There was a season where as the Biden administration took over, everyone was concerned that by the end of 2022, I think everything was going to get changed. Maybe it was 2021. Everything was going to change, and so there was some panic and people talking about different ways of doing generation skipping transfer trusts or other things like that in order to reduce estate taxes. But then that never happened, and so everyone's like, well, I'll start panicking again in about September of 2025. And I'm telling you, if you do feel panicked about this, start panicking now, because it will take that long for your attorney and your financial planner to work together to get you situated.
Yeah, figure it all out.
I think the most tragic change that's going to happen is we'll no longer be able to file our taxes on a postcard. Is that terrible or what?
I'm so
gonna
glad
miss
you brought
that.
that up. I'm so glad.
No, of course I'm being completely facetious, because tax planning has gotten more complicated as the years have gone on, even though it was supposed to get more simple.
Your tax return has gotten fatter because they tried to put it on a postcard, and instead they added a bunch of schedules. And anytime I'm looking at a tax return, I go to the old view. Thankfully, a lot of the software still has that. All right, so those are the law changes and the compare and contrast. Now the question is, what's the likelihood of these laws sunsetting, and what should you be doing about it? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. All right, third segment.
Dude, think of the irony that because we have the new view that doesn't tell you anything, and then we have a few pages later, we have the old view that does tell you a little bit. And that's the one that we look at with clients.
Do you think if they sunset?
Yeah, can you imagine? Like, will now the old view will be the new view, and the new view will be the old view, so you can see it.
It'll be the first time in our lives that we've been cutting edge and trendy.
Oh my word! I
Can't wait.
I am not smart enough to do this. I say that every day.
All right, so now planning implications. So no longer wearing your complain about Congress hat. Put your financial planner hat back on. What advice would you give today to help prepare or plan for those potential laws changing? I don't have them listed out. We're just going to free flow. Okay?
Okay, say it one more time.
This is third segment.
So what would you suggest someone consider doing today if those tax laws were going to sunset? Third segment. Financial planning is all about being proactive in your financial situation. And if we knew that the current tax laws were set to change 3 years from now, how would you proactively apply that in your financial life today? We're going to help you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out, as well as a lot of other content. Go to YouTube, search the Wise Money Show, and subscribe, follow us there. Guys, we've been talking about the likelihood, or not the likelihood, we're going to get to that right now, but the how the tax laws would change if they do sunset at the end of 2025. What are the chances this happens? What do you guys think?
Oh, man. I feel like none of us should even try to have the crystal ball on this one. Who knows? But I just I assume as if it is going to sunset. Maybe not in its entirety, though. I assume that some things will get rescued and preserved, because there were some good changes, and many of them were good changes. But at the end of the day, if there's going to be any kind of political pressure to try to raise taxes or anything like that, this is an automatic, easy one for Congress to do without looking bad. They can just not act. And in doing so, they effectively raise taxes on pretty much all Americans.
Okay, I'm going to go on the record here. Say it's 100% chance
That it will sunset?
it will sunset.
Okay.
I'm saying that. And I'm also saying the next change to the 529 plan is you'll be able to put a certain portion of your 529 plan directly into your HSA. But that's for a different show.
Oh, wow. I like this, Kevin.
Are you running for Congress too?
I like it.
Like that sounded like a campaign speech almost. Like this is going to happen. We're going to do it, folks.
And a chicken in every pot.
I wonder if the next election has will play a big role in this as well. But yeah, I wouldn't say I'm 100%, but I'm assuming that this will be the case. But here's the thing. You've got to plan for an uncertain future.
Always.
So this isn't unique. And therefore, I wouldn't set and reorient your entire financial life that this is going to happen, and therefore I've got to change everything right now. I wouldn't, and even Kevin at 100%, I don't think would say that. Because your financial life or your financial future, there's always an element of, well, we don't know. So give yourself as many options as possible. Knowing that there is that the current law is that the laws will change. How should this influence your planning today?
Which is a great question because the question is if I should either continue on a particular strategy that I'm pursuing, or if I should change my course. Will my course change be detrimental to my financial life? And so then I would say, well, if that would be the case, don't do it. So if you're looking at this and saying, hey, I've got 3 children and the child tax credit's going to be cut in half, do I work on having 6 children between now and 2025? I would say, well, you might want to reconsider that. Talk to your financial planner and your doctor. And so there are certain...
And your spouse.
Yeah.
Not necessarily that order.
Talk to your spouse first.
Yeah.
So you might say, well, there are limits to what I'm willing to do. But so to me, there are 2 things that just jump right off the page just because the folks we're dealing with right now. The estate tax, okay? Right now, I just talked with a client yesterday. This person dies today, they're fine. This person dies January 1st, 2026. Houston, we have a problem because if the state tax rate, exemption amount comes down meaningfully, they're going to be into that. So what would that person do if you're concerned about these things? One of the things you would do is you definitely want to look at updating your estate plan. Some of these things can be done as simply, if you're close, you might be able to get it done just by gifting. And so I say, okay, well, if I'm going to pivot my strategy and start gifting, what does that look like? This year, you can give $17,000 to anyone, and without having any kind of gift tax issues. Yeah. So for this person in particular, my recommendation was, all right, take that $17,000. You have a $17,000 spend, and pretend you had 3 beneficiaries. Are these 3 beneficiaries? Because the question is, if you died tomorrow, would each of these 3 beneficiaries be well suited to inherit their portion of your assets?
Well suited as in, are they prepared with the skill and character and everything needed to manage it? Is that what you're talking about?
No, I'm saying there are 2 things needed to manage money. You need skill and character.
Oh, okay.
So
totally different than what you're saying, Josh.
Along those lines, Josh. But no, so this is the question. Do they have those? Because as we've said, you can have one of those or both of those at 18, and you can lack one or both at 68. So skill and character are not necessarily age related. And so as I was talking with this client, they were saying, well, you know what, this one is really super responsible, and I don't have any concerns about this one. But this other one now, and I'm not using genders, so no one will be able to figure out who in the world I'm talking about. But they said this other one, that other, they spend all of the money before it's ever made. And I said, well, do you think that would continue? And if you look at this, if you say that my personal experience is, I don't have any experience with inheriting money personally, but I have vicariously inherited money hundreds of times. And it does seem like the most difficult money to hold on to is inherited wealth. And so the nice thing about a gifting strategy is you could get your beneficiaries started. So on that $17,000, here's the picture. I just drew it up. It's real simple. The first dollars go to, the financial planner. I'm biased, but I said if they don't have the skill and character, you need to hire a financial planner for them.
Yeah.
So
I thought you were saying the financial planner needed to be the beneficiary.
No. But you hire a financial planner on their behalf.
Got it.
With them, you say here's your money. The first dollars you're going to spend is you're going to hire a financial planner because you got to work on that skill and character piece. Then you could fund a Roth IRA. If you're in the state of Indiana, it might behoove you to open up that 529 plan, as Mike was talking about on a show a while ago, and say, hey, get it open, get started funding it. That money might end up at some point in time funding a Roth IRA for one of the beneficiaries. It might be paying off some student loans, might go into an HSA, who knows. So and then you just keep working through what would this beneficiary be funding? Because if that young beneficiary can fund tax-favored investments now, the power in those tax-favored investments is that money growing over a long period of time. And it's quite likely that if these beneficiaries are in their 20s, they don't have a lot of extra dough sitting around to fully fund a Roth 401k option or an HSA or fill in the blank.
So all those things that you were just sharing, those are strategies for people who could potentially get caught by an estate tax problem after the sunset happens.
Yep. So I'm saying gift the money to your beneficiaries and help your beneficiaries invest that money well. It's not, here's this money, go blow it. It's, here's this money, and it's going to be basically a bike with training wheels to get you used to having extra money around.
Sure. To me, most families right now, their estate plan doesn't have to be super elaborate because of the tax laws that exist at this moment. You know, you're allowed to leave behind what feels like a gazillion dollars. It's north of 24, 25 million, something like that, maybe pushing 26 now, that a married couple can leave behind with no estate tax issues at all. So you don't even have to have real clever, creative, planful estate plan, strategies in place, and you'll be fine. But that number is coming way down after this sunset. And so all of a sudden, some families that have accumulated a good amount of wealth, they're going to be caught potentially if they're not prepared to update their estate plan along the way or be implementing the kind of things that Kevin was just referring to.
Yeah. I actually wouldn't have thought we were going to start with estate planning, but glad we did. There's lots of other ways that you could be preparing right now for this tax law sunset. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Got the finger.
I didn't know what that meant.
Oh, usually Mike gives the finger.
I know. It's coming from you.
So I apologize. You know, we had this saying growing up, it's not appropriate. It's not perfect for, like, certainly the radio or even YouTube, but, you know, my dad would say, it appears as though you have diarrhea of the mouth and constipation of the brain. And that always gave me a
steady state usually.
That always gave me a chuckle because potty talk was just always funny to me for some reason. But I did have a little a run on. But dude, I'm excited. I am excited about that. Like, people need to, if they're going to be gifting money, because if you're an individual and you've got a $10 million, which, you know, inflation adjusted is about $1,500. What should you be doing with that?
Yeah. The thing, we didn't really make this point, but it's not very often that on the show we point people to say your CFP and your attorney need to be collaborating, right? We often talk about collaborating with your CPA and your CFP or your insurance agent. And this is one of those places where It's almost like people need to mark their calendar. You need to give a refresh or do a comprehensive review of your estate plan in the next year or two to be ready for these potential changes.
Yeah. All right. Fourth segment.
So that's a thing about a slat, thing about generation skipping, transfer trust. I mean, there's all kinds of different things.
Yep. All right. Fourth segment. We're still in this. So thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. I can't keep up with podcasts. There's just so many. I think I could, maybe that's my job. I could probably do 8 hours a day of listening to podcasts, and I'd feel filled up and maybe a little bit smarter, but no one would pay me to do that.
Do you think that job exists?
No.
And if so,
no.
what does it pay?
Listen, if I get to pick my own my job, it's pizza tester. We drove by. We were going to a travel baseball tournament. Drove by this huge Domino's warehouse, and Cindy and I were pretending that they had a room in there of pizza testers, and I was going to apply.
I need a shoehorn to fit in the bathtub if I was one of those. So I think it's important when you think about this. I don't know if we're picking back up with estate planning or where we're going with this, but go ahead.
Oh, yeah, I got it. So check out the Wise Money Shows on podcast wherever you listen. Search the Wise Money Show. Subscribe to it there. Yes, we are picking up the topic, Kevin. We're talking about tax laws sunsetting and whether you should be planning right now for it. And we've already said it seems like there's a really good chance that this happens. Therefore, don't make permanent changes in your financial life that would be fantastic if this law did sunset, but detrimental if it didn't. But really look at, what would be an improvement if the tax laws change and actually still be a benefit if you did it now anyway. And we were talking a lot about the estate planning implications of this. And Josh mentioned off air that, gosh, this is one of the rare reasons that doesn't get highlighted that often, that your CFP needs to be collaborating and working with your attorney, your estate planning attorney, to make sure that you're getting the right counsel, the right guidance. Josh, keep going. What are some other implications? What's something else that you should be doing right now within your financial life if these tax laws do sunset?
You know, for my entire career, I've been warning clients that throughout history, if you look at tax rates, they are constantly swinging back and forth from the low end of the spectrum to the high end of the spectrum and everywhere in between. And I've been warning that we're at the low end of the spectrum. And every time I go on record and declare that, Congress lowers the rates even further. But one of these days, I'm going to be right, and we really are going to see the low point, and rates are going to start drifting higher again. At some point, I'm going to be right.
Josh has this confidence because we've been saying interest rates are going up our entire life. And
that's my other blunder. That's right.
Well, I thought maybe that gave you some conviction that, see, been saying it for 22 years. I'm finally right.
Yeah, that's right. Broken clock, I guess. But here's the point. If you believed that there's more upside potential on tax rates, things are more likely to go up than to go down from the rates that we enjoy right now, then to me, anything that you can do to pay your taxes at these low rates and avoid them in the future when we could potentially be in a higher tax situation, that's a strategy worth paying attention to. Yep. And of course, the one that is often at the top of our list when we're talking about prepaying your tax essentially is a Roth IRA. That could be taking money that you are earning this year and contributing it after you've already paid your tax, getting it into this Roth IRA and just letting it grow, contributing it into, investment accounts that are growth oriented, not something that's real calm and safe and stable. That may be important for some parts of your portfolio, but a Roth IRA that has years, maybe decades to grow, give it the ability to truly give you exponential or compounding growth over time. And the beauty is that when you pull money out of the Roth IRA in retirement, presumably, you're going to be using that money tax-free at that time. And I've often, I had a client one time say that they compared the Roth IRA to a forever stamp. And I loved the metaphor at the time. She happened to work for the post office, so of course that's where her mind went. But it's like once you've got a whole roll of forever stamps, it doesn't matter what they do to the price of stamps because you know my stamp is good, right? And that's how the Roth IRA works for you as well.
So normally when you're comparing and contrasting whether you fund your retirement pre-tax or Roth, pre-tax, if you're in a high tax bracket today and low tax bracket tomorrow, you win. And for the Roth IRA, if you're in a low tax bracket today, you don't care what tax rates are in the future, right? And yes, technically, if tax rates are higher in the future, then you win, but you actually don't care. And so I think if I were to say just really quickly, and we can dive into these more, but 3 things that you should consider within your financial plan to help prepare for the potential that tax rate sunset: Roth contributions, Roth conversions, use a 529 plan. Because they all have similar features. The Roth contribution, like Josh said, you might be in the 22% tax bracket today. That's the 3rd tier, and you might say, oh, that feels high. Well, compare that to the 25% tax bracket, which is the 3rd tier, or even if you're in 24, contributing to the Roth 401k, that may be a better tax rate to pay taxes at, so that you're avoiding 25 or 28% out there in the future. Along with those contributions, I would consider shifting your matching contributions to be Roth, which is now a thing, actually. I don't know of anyone that's able to do it just yet, but legally you can. Shift your matching contributions from your employer into the Roth. Consider that simple IRA. Now you can have a simple Roth IRA at some point soon. It's legal once it's available. So I would consider having your contributions be Roth. If you're on the bubble, knowing that these tax laws could change, I would consider Roth contributions.
And we serve a lot of retirement plan participants, and Mike's talking about this whole Roth thing, and I do think the Roth IRA is his favorite child for sure. But the thing is, with this there are people that aren't paying any federal taxes that are contributing today pre-tax to their retirement plan. So this is where you need to be working with your financial planner who does tax planning, because if you're not working with a financial planner, if you're working with someone who just sells investments and they say, hey, I don't give you tax advice, go get that from the person that prepares your taxes, that you probably need to be looking for a planner, make sure that planner is certified, and get this figured out.
Especially as it relates to the second point, which was Roth conversions. It seems like it was slow at first, but I've had more and more people convert into the 24% tax bracket because we're getting closer to that 24% tax bracket being 28% or even, higher than that.
That's right. Similar. There may be some listening today who have recently inherited money from a family member that maybe it was an IRA or a 401k or something like that, and you've been given a 10-year window that you have to pull money out of those accounts. You got to completely clean them out. And that's due to, what was that, Secure Act 2.0 or 7.0? I can't remember.
1.0 actually. Yeah.
The point though is you don't have the rest of your life to pull the money out of that inherited IRA, but you also don't have to take the full 10 years necessarily. So what if you needed to front end load some of those withdrawals, if that made sense for you from a tax standpoint? Just because we know what the tax rates are today, we don't technically know what they're going to be in 2026. We know what they're scheduled to be, but will that play out? That's everybody's guess, and we've gone on record earlier in the show to give our guess. But the point is, you always want to plan based on the things that you know, and this is just one of those places where working with your certified financial planner and your CPA to do multi-year tax projections, that ultimately is the answer to this question. What should you do about these sunsetting rules? Get started planning right now, because there may be some things that you have at your fingertips right now, strategies that could go away in the next couple years. don't burn through some opportunities by not paying attention.
That's exactly right. And if you have the ability to fund a Roth IRA, your income's not too high, then I would capture that so you've got dollars growing tax sheltered, tax free. The other one that we haven't mentioned yet is the health savings account. And you might say, well, wait a second, if tax rates are going up, I don't necessarily need the deduction now. I want it in the future. No. That game would be getting as much money growing tax sheltered and future tax free as possible, which is what the HSA is. And certainly, if you can fund an HSA out there after tax rates go up, you'll want to do that too. But funding it now in anticipation of these tax law changes makes a ton of sense. Work with your CFP. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.